Hi, I'm Scott Mentzer with Orchard Hill Mortgage, and this is your weekly mortgage update. Okay, let's take a look at last week's mortgage rate recap. So rates were volatile last week as expected, but ended the week better as markets grew convinced the Fed would be forced to make March the last policy rate hike and would have to cut rates as soon as June despite Fed members signaling otherwise. The week ended with hope that we might see rates drop further this week based on market sentiment from Friday. All right, so let's take a look at the rate forecast for this week. The outlook for rates this week not looking good as they did Friday after seeing rates move higher to start the week due to market sentiment shifting. Markets now speculating that the Fed could raise rates again in May, and although still anticipating rate cuts, markets now think those cuts will come later in the year. The outlook shifts quickly, and any news that leads markets to anticipate an end to the Fed rate hikes will help mortgage rates. All right, so let's take a look at what's affecting rates this week. Two things: economic data and the Fed. Data later in the week includes GDP numbers and PCE inflation data. Signs of reduced inflation or economic slowdown could help rates. The Fed, as markets anticipate future Fed rate movements, mortgage rates will move up and down. Fed members speaking this week could swing sentiment as well as any bank drama news. So let's just dive into this a little bit further and talk about why economic data or data, depending how you want to pronounce it, really affects mortgage rates. So right now, inflation has been a major concern for the Fed, trying to slow inflation, but that has caused mortgage rates to rise as they raise the Fed rate. So any economic data that shows that inflation has cooled or slowed down, and numbers that showing that our economic growth is also slowing, will be good for mortgage rates. Most likely not good for the economy in general, because it could show that we're going into a recession. Traditionally, during a recession, mortgage rates have gone lower. So, for people buying homes, a recession could be a good thing as long as people still have jobs. So remember, the Fed has two main goals: to control inflation and continue to regulate job growth in this country. Unfortunately, when everybody has a job, inflation goes up. When they control inflation and get it to go down, then unemployment rises. So again, their two main functions are control inflation and control unemployment. So, if we start to have unemployment to go up, then mortgage rates could go down, along with the Fed then slowing their increases of their Fed rate. Just wanted to kind of talk about that real quick to have a better understanding. Well, that is all I have for this week for the mortgage update. Thanks for watching. Hopefully you'll tune in again next week. Scott Mentzer, Orchard Hill Mortgage. Have a great week. Bye.